Hey traders, Jason here from Leavitt Brothers. A lot has happened in just the last week since I last posted a video, or I don't know, maybe nothing's happened, maybe nothing has changed. We've gotten some huge moves in both directions and volatility has exploded. That is a big change in character. We went from having tiny range days where the S&P barely moved 10 points to huge days where it moved 10 points in a couple of minutes, and some days we've had 1,500 point days. The big question now is this it? Is the bull market that started in 2009 over? Is a top in place? Let's look at a few charts and put things in perspective. Here's the top in 2000. Okay, I've said numerous times tops take time to form. They tend to be long and drawn out, and even in the worst of times, they take months to form. And while they form, it's obvious deterioration is taking place beneath the surface. Look at this chart from 2000. Okay, the top was 10 months in the making before the S&P finally broke down, took out a support level, took out its 50-day moving average, moved up here, got rejected by its 50-day moving average, and then officially moved south. Okay, it took a long time. Even though the dot-com bubble was bursting, it still took like 10 months. Here is the top from 2007, 2008. Okay, like the 2000 top, this top also took a really long time to form. In fact, it took an entire year for a top to form, for a trend line to form. The trend line got taken out, 50-day moving average got taken out, and we got some, we got some distance from it. 5 months later, we came back and tested the 50. Okay, it's actually the 50-week moving average, not the 50-day. And then the market finally headed south. So again, it took a really long time. The greatest financial crisis since the Great Depression was unfolding, and the market still took at least a year to top. Here's today's chart. Okay, with a new high registering just last week and the 50-week moving average being like way down here. Okay, there's no evidence the top is even in the beginning stages. Okay, none. If a top was forming, the S&P would likely trade sideways in a range through the summer into the fall before any meaningful and permanent move down started. Okay, but even if this happens, we'll have plenty of time to adjust. Let's look at a few indicators that hint or kind of give us indications that tops may be in the process. Since tops take time to form, what takes place beneath the surface while they're forming? Here is, okay, I should back up a second. One hint of a top is investors' appetite for risk. Okay, if they prefer stocks over bonds, then the market tends to do pretty well. If they're looking for the safety of bonds instead of the growth of stocks, then that's a hint that that the market may be in trouble. Okay, so here's the S&P 500 down below, and here is the S&P 500. Hold on, turn that off. Here's the S&P 500 relative strength chart versus bonds from 2007. Okay? Okay. In October 2007, when the S&P 500 was making a new high right here, the relative strength chart of stocks versus bonds put in a lower low. Okay. This told us that even though the market was moving up, investors were aggressively putting money into bonds. It was a warning, and the market fell hard soon after. And that was it. That was the top. Okay. This divergence plays out on shorter time frames too. Here is 2015. Okay, in July and early August, the market was flat, as you can see here. Okay, but stocks started to underperform bonds, as you can see here. And the market fell pretty hard right after that. Okay, here's another one. This is the end of 2015 and the beginning of 2016. The market moved up. Okay. Right here in October, beginning of November, and almost matched its highs from the previous summer. But at the same time, the relative strength chart of stocks versus bonds couldn't quite match the high. Okay, there was a much bigger gap. So even though both put in a lower high, the gap here told us that stocks were losing their momentum versus bonds. Okay, and then as you can see, the market kind of drifted sideways for 2 more months, and then the bottom fell out. Okay, here's today. Okay, no such divergence exists. The relative strength chart of stocks versus bonds broke out in September here, came down and tested in November, and has been moving up since. Okay, maybe if the market runs up to a new high and this relative strength chart puts in a lower high, we'll get a warning, but it hasn't happened yet. Okay, so for now, stocks hit a new high last week. The relative strength chart of stocks versus bonds hit a new high. I'd say everything's on board and the market is well supported and there's no evidence that a top is forming. Let's look at a few more. Here's the S&P 500 down below, and the AD line of the S&P 500, the AD line at the NYSE from 2007 and 2008. Okay, while the S&P was putting in a new high here, the AD line was putting in a lower high. That was a warning. Okay, the AD line continued to drift lower, and eventually it took out its 50-day moving average. Okay, then it got rejected by its 50-day moving average in the spring of 2008. And then the market officially headed south. Okay, the AD line gave us a clue. It couldn't match the market's higher high. It told us there was some deterioration taking place beneath the surface. Here's today's AD line. Okay, up and away. Okay, no divergence is forming. No warnings are issued. When the S&P hit a new high last week, the AD line did the exact same thing. Let's look at another one. Here's the S&P 500 versus the high-low differential at the NYSE from back in 2007 and 2008. Okay, the high-low differential is the cumulative count of new highs minus new lows. Okay, like the AD line, when the S&P 500 hit a new high, the high-low differential put in a lower high. Okay, this was a warning. Okay, either less individual stocks were hitting new highs or more were hitting new lows. In either case, it doesn't really matter. A negative divergence formed and gave us a warning. Here's today's version. Okay, the chart can't be much more bullish than this. There is no hint of any warning. Okay, and since it takes several months for divergences to form, we can be confident that either a top is not in place, or if a top is in place, at the very least, the market's going to move sideways for several months and we'll have plenty of time to adjust. Let's do one more. Here is the percentage. Here's the S&P 500 down below, and up top we have the percentage up of S&P stocks trading above their 200-day moving averages, okay, in 2007, okay, 2007, 2008, okay, a lot of big institutions, a lot of institutions that have big money to throw around. They look at the 200-day moving average as a key moving average. When stocks are above it, they're interested in buying. When they're below, they're not going to buy them. So the number of stocks that are either above or below this moving average is pretty telling, okay. While the market was putting in a new high in October 2007, okay, the percentage of S&P stocks that were trading above their 200-day moving averages had dropped from like the 90% level down to the mid-60s range. Okay, this was a tell. Okay, something was going on. The market was at an all-time high, yet over 100 S&P stocks dropped below this key moving average. Okay, today's chart looks like this. Okay, the percentage of S&P stocks trading above their 200-day moving averages has held steady for many months. Okay, there are no warnings here. Okay, now if the S&P bounces to a new high and this percentage drops, then we'll have to reevaluate. But for now, the market is on very solid ground. Okay, tops typically take time to form. Okay, you typically can see several months of deterioration before a top is put in place, but it didn't happen this time, which tells me it's not a top. If the indicators would have been trending down for a couple of months, fine, then maybe a top would be in place. Or if bonds had been favored over stocks, then again, maybe then maybe a top would be in place. But I actually think some volatility traders got caught on the wrong side of a carry trade and had to unwind. And once the computers picked up on the downside momentum, they piled in. In my eyes, the market is in good shape. Okay, there's no evidence a top is forming. Okay, as far as the character of the market, for the foreseeable future, there will be a lot more movement. Ranges will be bigger. Stocks may run up or down and then quickly reverse. This isn't yesterday's boring market where trades took a lot of time to play out. We're going to get some big moves and then a give back of those moves. Okay, risk is on, not off. But given this, the worst is likely behind us. Okay, yeah, we could possibly, we could do a double bottom and test the lows, but even if we take out the lows, I'm guessing the market bounces back pretty quickly and heads north from there. Okay, if you zoom in too close and get emotionally wrapped up in the big intraday movements, okay, it'll be tough to stay the course when we get the occasional big sell-off. But if you keep in mind the overall trend is solidly up and the longer term indicators are in good shape and that a top is very likely not in place, you'll be ready and willing to put money to work. Okay, Come check us out at Leavitt Brothers. We find the best stocks and the best groups, we profile them, and we bring them to your attention so you can make money. You still have to do some work, but heck, you could start every day and every week with a really good list to work from. One good trade pays for your subscription for an entire year. Come check us out.